Hello, and welcome to another stock analysis on Stock Market Palantir. Don't forget to subscribe and drop your comments. Now, let's go hear our analysts.
Welcome to the Stock Market Palantir. Today we are going to talk about AVGO, that's Broadcom Inc. The recent Q4 2025 earnings event really gave us one of the clearest market paradoxes we've seen this quarter. Operationally, the company delivered a substantial beat and raise. They reported revenue of $18.02 billion and adjusted EPS of $1.95. And this is the critical part. Their engine of growth, the AI semiconductor segment, surged 74% year over year to $6.5 billion. Yet, in the immediate aftermath, the stock just experienced a sharp sell-off, trading down between 5 and 10% on pretty significant volume.
Right. And that specific market action, incredible strength leading directly to weakness, that's the core tension we really have to analyze. The question is, well, it's pretty clear, was this volatility a justified repricing driven by genuine fundamental anxieties that the guidance revealed, or was it just a temporary market dislocation, a technical flush that, savvy investors recognized as a gift?
My position is that the sell-off was indeed a temporary structural event. It was a true valuation reset that's now creating an attractive strategic buying opportunity, all driven by a basic misinterpretation.
And I'm going to argue that the price action was a necessary and frankly valid response to some very serious fundamental anxieties, particularly around margin structure and the complex extended timing of their biggest speculative catalysts.
I see why you think that, but let me give you a different perspective on the operational reality. The selling pressure was a technical flush, completely, inconsistent with the quality of the execution. Broadcom isn't just growing. They are undergoing a fundamental valuation regime change as they pivot to capture the AI market. And this shift, I believe, will ultimately prove highly accretive. The AI semiconductor segment didn't just meet expectations, it surged 74%. And management projected further acceleration, guiding that segment to double year over year to over $8.2 billion in the next quarter. This is absolute market dominance in a critical sector. Now, the source of the market's anxiety, that guidance for a sequential 100 basis point decline in gross margins, is just wildly misunderstood. CEO Hock Tan was clear. This margin trade-off is the necessary price of admission for securing an unassailable strategic moat in custom silicon or ASICs with the largest hyperscalers. So while the percentage margin may compress slightly, the massive increase in the sheer volume of AI revenue means the business is entirely accretive to operating margin dollars. They're sacrificing fractional percentages for enormous long-term strategic relevance and, overall cash flow growth.
I'm sorry, but I just don't buy that margin argument as purely a short-term tactical move. Let me tell you why the sell-off was justified. It was the market's response to the collision of, frankly, extraordinarily high expectations with complex and very revealing forward guidance. You have to remember, Broadcom historically commanded a premium multiple because of its highly protected, high-efficiency business lines that delivered 70% plus gross margins. This strategic shift toward custom silicon fundamentally alters that economic profile. The issue is leverage and pricing power. See, when AVGO develops custom silicon, these application-specific integrated circuits, the customer, the hyperscaler, brings their own intellectual property and guarantees massive volume. This kind of partnership inherently limits Broadcom's pricing power compared to when they sell their standard proprietary connectivity chips. So you risk what I'd call profitless prosperity, where revenue scales dramatically, but the return on that revenue, the efficiency metrics, they deteriorate structurally. It's a move toward becoming a utility. And the second critical factor was the timeline recalibration, what I call the OpenAI air pocket. The market had priced in an immediate material contribution from that rumored massive OpenAI deployment. Management was forced to clarify that this 10-gigawatt deployment is a multi-year journey, with meaningful revenue only hitting the books years from now, possibly 2027 through 2029. That clarification it vaporized a near-term speculative catalyst, creating a massive and, I think, justified air pocket in the valuation.
I acknowledge that the margin dilution is explicit and Yes, the timeline for the largest speculative deals has been extended. However, I believe focusing on that 1 percentage point reduction really misses the forest for the trees. This strategic positioning is absolutely critical. AVGO is effectively becoming the anti-NVIDIA hedge for the world's largest data centers. I mean, hyperscalers are desperate to reduce their reliance on one single vendor for AI infrastructure, and they are actively looking for alternatives. Broadcom is the necessary toll taker for that entire effort. They provide the fundamental open Ethernet solutions, the Tomahawk and Jericho switches, which allow these hyperscalers to build their own systems, bypassing the restrictive, closed ecosystems of the dominant player. This strategic, high-volume ASIC revenue, it secures their position as a long-term infrastructure partner. And that is a moat you cannot quantify solely by looking at a gross margin percentage.
That is a compelling strategic argument for securing long-term customer lock-in, but I would frame the valuation impact differently. The market's job is immediate pricing. It previously priced AVGO as a high-growth and high-margin champion. Now it has to contend with the high-growth, lower-margin profile of an infrastructure utility. And a utility profile simply demands a lower earnings multiple because the business model is less efficient, regardless of the overall dollar size. Furthermore, we can't view Broadcom in isolation. At the time of this report, we saw broader AI angst manifesting across the sector. Companies like Oracle, for instance, were signaling these massive, sustained capital expenditure hikes to support their AI cloud ventures. So investors are getting more and more skeptical about the long-term ROI on this kind of AI infrastructure investment. They're fearing the cost of building these systems might outweigh the immediate returns. Broadcom, by publicly revealing its lower margin strategy, is paying the price for that collective sector skepticism.
I acknowledge the sector-wide nervousness regarding CapEx ROI, sure, but the specific depth of AVGO sell-off, that immediate 5 to 10% drop, was not solely driven by these fundamental concerns. It was dramatically exacerbated by market mechanics and structural positioning, a pattern that to me points to significant mispricing. We saw classic retail sell institutional buy divergence, which suggests the narrative was being manipulated. Leading up to earnings, if you look at the data, the off-exchange short volume ratio for AVGO was consistently elevated, between 51 and 57%. This tells you institutions were heavily hedging their bets, maybe distributing shares into the rising price, selling high to retail buyers. Then, immediately after the drop, the dark pool indicator, the DPI, remained net bullish. This is crucial. DPI measures institutional order imbalances, and that net bullish reading confirms that the sophisticated smart money used the public panic selling to reaccumulate shares aggressively at the lower $360 to $370 prices. They seized the margin compression narrative to shake out less sophisticated investors and just buy the dip.
Okay, that's an interesting point regarding institutional positioning, but I would argue that market structure is merely a multiplier, not the fundamental driver. The market needed a concrete reason to collapse the speculative structure built around that $400 strike price, and the delay of the OpenAI catalyst to 2027 and beyond provided that very concrete reason. And you speak of institutional buying, but have you considered what that accumulation really represents? I mean, it often reflects risk-managed hedge rebalancing, covering shorts and reestablishing long-term neutral positions, rather than a renewed, conviction buy on the company's immediate fundamentals. The original high price was based purely on a buy-the-rumor speculative premise that required an explosive near-term catalyst. When management pulled that timeline, the speculative premium fundamentally had to be burned off, regardless of how institutions subsequently managed their exposure. The core business reason was the timeline, not the derivatives market.
But the sheer violence and the speed of the selling demonstrates the mechanical influence. The derivatives market exerted this massive gravitational pull, a concept known as gamma pinning. To explain that briefly for listeners, the $400 strike held the largest concentration of open call options, a massive call wall. When earnings failed to provide the necessary jump, those call values evaporated. Dealers who were short those calls and had bought vast quantities of stock as a hedge were suddenly forced to sell those massive hedge positions into the market. This creates a self-reinforcing structural downward spiral. This de-risking event wasn't driven by fundamental anxiety. It was a required adjustment by options market makers. And structurally, the fall stabilized precisely at the 375 put wall, where the heavy put open interest forced dealers who were short puts to buy stock to remain delta neutral. That established the concrete floor where your noted institutional buyers began to step in. The structural forces amplify the impact of the fundamental news far beyond what was rationally justified.
You're making a strong case for the mechanics amplifying the move, I'll give you that. But let's return to the strategic reality you introduced. You mentioned the margin trade-off is supported by the VMware integration. We need to explore that cushion fully. For this new ASIC strategy to work, the VMware segment has to perform spectacularly to absorb the volatility and lower efficiency of the AI push. What evidence do you have that VMware provides sufficient high-margin stability to justify that kind of strategic risk?
That is precisely the genius of the acquisition. The high-margin, sticky subscription revenue stream from VMware is not just exceeding expectations, it provides the necessary operational cushion that allows CEO Hock Tan to absorb the inevitable volatility and lower gross margins of the custom silicon pivot. VMware's recurring revenue stream is consistent, it's reliable, and it's fundamentally high margin. This financial foundation gives Broadcom the security and the capital expenditures necessary to pursue high-risk, high-reward strategic positioning like challenging NVIDIA's dominance. The market failed to properly value this financial architecture. The high-margin legacy business and the newly integrated VMware cash flow stream allow them the strategic flexibility to engage in these lower-margin, volume-intensive deals with hyperscalers. They're leveraging their strong balance sheet, which very few competitors can match, to cement these multi-year strategic partnerships. It's an asymmetric risk profile. Low margin percentage, sure, but massive strategic relevance and enormous total dollar profit.
I acknowledge the financial architecture is solid, and VMware is undoubtedly providing critical cash flow stability. However, we should clarify a recurring misconception in the material about the stock's long-term capital history, because it often confuses investors looking at the price action. Many people reference reverse splits when discussing the stock, and I want to be explicit. Broadcom Inc. AVGO has never conducted a reverse stock split. The confusion stems from the 2016 AVGO Broadcom merger exchange ratio, which was 0.4378 shares for one legacy BRCM share. And while it felt like a consolidation, it was a merger mechanic, not a reverse split intended to manipulate the share count upwards. The only recent action affecting the count was the 10-for-1 forward stock split in 2024 to increase retail accessibility. And this clarity matters because the current volatility is rooted in fundamental value perception, not just share count confusion. While the long-term moat is undeniable, the market is correctly asking if the firm is transitioning from a premium chip designer to a high-volume infrastructure utility. And that distinction mandates a different, lower multiple, because efficiency has been traded for volume.
I disagree that the transition warrants a permanently lower multiple. While they are accepting a shift in margin profile, they are also positioning themselves to be a dominant, non-displaceable partner in the most critical infrastructure buildup of our generation, AI. The market is currently valuing AVGO based on its historical structure. But the analyst community that razor targets like KeyBand to 500, Morningstar to 480, they see the emerging structural opportunity. They see the sustained dollar accretion supported by VMware and the essential role in the anti-NVIDIA ecosystem. The volatility was a fleeting cost of admission to this new, more valuable strategic positioning.
And my position remains that the volatility highlights genuine complexity and risk. While the strategic moat in custom silicon is impressive, the market is demanding greater prudence because the immediate cost of that moat, lower gross margins, is now an explicit communicated reality. And the timeline for the largest speculative revenue has been pushed significantly into the future. That combination necessitated a structural decline in the multiple.
So, my summary is firm. The operational execution is robust. The AI revenue path is accelerating and massive. And the structural market forces created a significant temporary dislocation that, well, it created a major buying opportunity. Institutional accumulation and professional analyst consensus validate this perspective.
Ultimately, navigating this valuation reset requires investors to determine if the incredible long-term strategic positioning as the critical toll taker in AI infrastructure outweighs the very real explicit and near-term pressures on its margin profile and the timeline delays for speculative revenue recognition.
Indeed. The complexity around AVGO's margin pressure versus strategic positioning will continue to define its stock performance in the coming quarters. Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights and see you in the next video.